Good morning. It's the 8th of August, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital. We don't have a take for today, so here are our top stories and themes for today. Indian markets are tracking global recovery, now poised to gain further. The rupee falls again, closes in on 84 rupees to a dollar, and the Reserve Bank of India steps in. Where are the Indian stock markets right now, and how investors are still pouring in? The government relents on taxes on sale of property and other fine print that matters. And sales of hybrids and electric vehicles overtake all vehicle sales in China for the first time.
This is a core report with Govindraj Ethiraj.
Indian markets track global recovery. So now the Indian markets have finally begun tracking the recovery in the world markets after the big sell-off over the weekend and into Monday this week. Wall Street was holding firm overnight, and that could set the precedent for both Asian Open as well as India this morning. So the larger question, of course, is where are the Indian markets headed at this point? And before that, where do they stand today? While the Indian markets have swung low and back up again, not fully though, the fact remains that nothing much has changed fundamentally, which is corporate earnings or macroeconomic parameters. But stock prices and value are not necessarily only a function of fundamentals. Sentiment obviously matters, and more on that shortly. The benchmark indices were strong. The BSE Sensex was up 875 points to 79,468, and the NSE Nifty50 was up 305 points to 24,297. The Business Standard says as many as 44 of 50 stocks of the Nifty50 ended higher, with companies like ONGC, Coal India, Adani Enterprises and Ports gaining up to about 7.5%. On the BSE 25 of the 30 stocks in the BSE Sensex were in the green, with again gains led by Adani Ports, Power Grid Corporation and JSW Steel up to about 3.5%. Not surprisingly, all the mid-cap and small-cap indices were also up sharply as the bounce back continued. The rupee hits a fresh low. Well, the stock markets might be rising, but the rupee is not against the dollar, falling to another all-time low on Wednesday, thanks to continued unwinding of carry trades and on-dollar demand from local importers, according to Reuters. So the rupee fell to a record low of about 83 rupees 97 paise to the dollar before closing at 83 rupees 95 paise to the dollar, which is its weakest closing ever. Now, all of this is a little significant because we're approaching 84, which is seen as a somewhat dangerous mark. Now, the rupee has hit record lows for 4 straight sessions, which in turn triggered intervention by the Reserve Bank of India, which apparently also asked, according to Reuters, some large banks to avoid excessive speculation against the rupee. And this comes back to the fact that if the rupee touches 84 to a dollar, it could create some concern in the market. Reuters also reports that the Reserve Bank of India asked these large banks to not add to their existing positions against the rupee in a bid to support the currency. Officials from the Reserve Bank of India's Financial Markets Regulation and Operations Department apparently called up big banks on Tuesday when the currency, that's the rupee, was at risk of breaching that 84 rupees to a dollar level in the spot market. So the rupee apparently is now the worst performing Asian currency in the last month, pressured by the unwinding of trades that used the Chinese yuan to fund long bets on the local currency, says Reuters. Now let's return to the stock markets. A big question to me at least is, where do Indian stock markets stand, and then where do they go from here? What are the forces that are at play, and where are the pressure points the highest? For instance, while earnings are steady, as are other macroeconomic factors, there is no real propelling factor to keep pushing the indices up, and surely not at the pace we've seen before or for some time. On the other hand, investor funds are still flowing into the markets. Gaurang Shah, head investment strategist at Geojit Securities, tells me. Now, there could be good reasons for that, including the fact that savers are quite desperately looking to beat inflation and build aspirational savings. Or could there be other reasons? I asked Shah, however, the more fundamental question where I thought it's a good place to start. Where are we right now?
So where are we in terms of the markets? I think we are possibly positioning ourselves for a consolidation period with respect to the events that unfolded the beginning of the week on Monday and the kind of imported issues that we had with respect to, suddenly in a matter of 24 hours, there were talks in the market about US going into a recession. out of the blue, Central Bank of Japan went and increased the interest rates by 0.25 basis point. And always behind the backdrop is the situation, geopolitical situation in the Middle East. So if I have to put all the things in perspective, well, we knew it in the beginning of the year that US is going to change its stance and there is going to be change in interest rates. Bank of Japan was a surprise, whether pleasant or unpleasant, depending upon which side of carry trade you are. And with respect to geopolitical situation, Govind, I think we'll have to face the situation as and when it unfolds and we have to react. So of the three, I think one thing that worries me is the geopolitical situation because we don't know when, in what form, and in which manner is the situation going to unfold. So our markets, I feel there has been overreaction that we saw and that led to the kind of sharp correction we had. And then we are trying to stabilize. Monday sharp fall. Yesterday we started off with a positive note but ended up in a negative bias. Today, I think we closed at the high point of the day. So there is a brief period of consolidation going, but I think the buying is visible at lower levels, whether it was Monday, whether it was Tuesday, or whether it was today, Wednesday. So this buying is going to come in. US Fed will do what it has to do. Bank of Japan will do what it has to do. Tomorrow, more importantly for me, will be what the RBI governor has to say on the recommendations of MPC, that is Monetary Policy Committee. So overall, my sense is that if you're not really worried about the short to medium term, this is a buyer's market rather than a seller's market. Only thing is you need to have a longest time horizon and possibly cherry pick your investment ideas.
Right. So, in terms of direction, until maybe a few days ago, it was clear that we are directionally heading upwards, but maybe in a slower way. The factors that drive it, which could be, let's say, corporate earnings or macroeconomic factors, haven't really changed. So, do you feel that that's going to remain the case, that nothing may change much? I mean, things will continue to do well, as in companies will continue to do well, macroeconomic stability might be there, but we are now going to be more hit by what's happening internationally.
Exactly. And unfortunately, we had one more event, which I didn't mention, that is the coup in Bangladesh. We already had two notorious countries to deal with, that's Pakistan and China. Now we have one more, depending upon who's going to head the government over there. Geopolitical situation is going to be in the spotlight, possibly for some time. One thing that I would highlight is positive is the monsoons. Govind, I think it's been far better than what it was last year, though some places there is excess monsoon and there is flood-like situation. But overall, I think we should end up on a positive note. That's what the Met Department is predicting for the month of August and September, whatever remains of the monsoon season. And earnings front, what I can say, Govind, is that there are no large dark spots or no red flags. One or two cases here and there, company specific, I don't rule out. But if I have to sum up the earnings season, because I think next week is going to be the last week for the first quarter earnings, then we'll have curtains down and they'll be possibly looking for second, third, fourth quarter. So to sum it up, I think the earnings has not been bad. That's possibly something a positive note. That's the reason why I said that you need to cherry pick your investment ideas in terms of long-term investments.
Right. And last question, as we look ahead, one of the strengths of the local market obviously has been the continuous and consistent flow of funds, including through mutual funds and investors participating through that route. Now, that does not seem to be counterbalancing what we are seeing outside, which is the triggers that are coming in from outside. Just to go back to what you said earlier as well. So you talked about all the international factors, including geopolitics. I mean, most of it is geopolitics, but Middle East, South Asia itself, and so on. So why is that? What has changed?
So I'll tell you one thing, Govind. On Monday, I was on some channels. I did almost about 4 shows, caller shows that were. And in all the 4 shows, Govind, out of 10 questions that came to me, 8 callers, investors I'm talking about, wanted to know where to invest. They had the money to invest. It is not like earlier times wherein the retail investor would, fear and worry about the market fall and stop the SIPs or stop their direct investment into equity markets. I think the retail investor has matured to a great extent over the last 4 to 5 years. That's what I have witnessed personally at ground level because we interact with a lot of retail investors. We conduct investor awareness programs wherein I travel length and breadth of the country. And just about last month, I had the honor to conduct almost about 3 or 4 IPs. And all those IPs, including caller shows that I do, people are now wanting to know where to invest. So they are not worried about the market fall. Markets, all markets are vulnerable to both sides of moves, that is up and down, depending upon what kind of a backdrop of environments you're going through. But I think the retail investor is matured. So whether it is going to come in via SIP whether it is going to come in via lump sum investment into any mutual fund or whether it is going to come in directly via equity. I think this number as we go forward is going to grow. Monday itself, I think FI sold somewhere close to about in excess of 10,000 crores and the domestic institutions bought about excess of 9,000 crores. Yesterday, I think the figure was also more or less similar. I don't know what happened today. So I think we are going to have that liquidity strength from the domestic institutional investors as far as any kind of selling pressure from the FIs is concerned. What remains to be seen is, what happens in our neighborhood with the kind of situation that has developed over the last 2 or 3 days. I think that is something that may possibly, bother us a little bit. I'm not saying it will be a deep concern, but it will bother us a little.
Right, Gaurang, thank you so much for joining me.
Thank you, Govind. Always a pleasure. All the best.
Steel prices plunge. Earlier this week, Tata Steel complained that low-cost imports from China and Vietnam, which apparently was a conduit for materials flowing from China, were impacting steel prices here and could hurt investment plans of steel makers. Tata Steel's point is that Chinese steel companies were not making money anyway at these prices and were most likely keeping their plants running. Now, that's my interpretation. Meanwhile, data from commodities consultancy Pigment, quoted by Business Standard, says that steel prices in India have fallen to the lowest level in more than 3 years thanks to higher imports and subdued exports. India is the world's second largest crude steel producer, around 130 million tons per year, and turned net importer in last year, something we spoke of in the core report earlier, quoting a CRISIL report, which in June said that India had become a net importer of steel, but the amount is somewhat small, or rather very small. It's about 1.1 million tons. But that figure is a little important because India has been a net exporter since 2017. Reliance consolidates its balance sheet. Reliance Industries has said that it's consolidated its balance sheet and is now ready for the next level of growth. Its chairman and managing director Mukesh Ambani told shareholders in an annual report for the financial year ending March 24. He said that Reliance has consolidated its balance sheet after the previous round of capital expenditure and is now ready for the next level of growth. Elsewhere, Reliance Jio, which is the telecom company, reported a subscriber-based jump of about 42 million to 482 million in all for the last year. The report also said of the total user base, over 108 million subscribers have migrated to its 5G network, and Jio now commands 60% of India's data traffic. And there are some more interesting insights in the Reliance balance sheet, which I will come to tomorrow, but I can give you a general hint. So the one insight is that Reliance's biggest business is still oil to chemicals with a revenue of about 564,000 crores or about $68 billion, which is followed interestingly by retail, which is about 3 lakh crores or about $37 billion. And finally, it's also followed by digital services and then media and entertainment, which is quite small. Oil and gas is also relatively small, about 24,000, but that's because it's all kicking in now, which is its deep water oil and gas fields and coal bed methane blocks. So the profitability split is a little different and is still weighed largely in favor of older businesses and are now powering the newer businesses, but more on that tomorrow. The last tax moves. So the government of India took a step back after mostly middle-class ire against a proposal to impose higher long-term capital gains taxes on sale of property, which was announced 2 weeks ago in the union budget. The government had said in the union budget, delivered on July 23rd, that the long-term capital gains on real estate sales would be reduced to 12.5% from 20%. But what the government also said that they would remove a benefit that allowed individuals to adjust property prices for inflation when calculating capital gains for tax purposes. This is also called indexation. This effectively raised the profit on each sale and hence the tax bill, according to Reuters. The government will now offer taxpayers the option to choose between the new 12.5% tax rate without the inflation adjustment or the old 20% rate with inflation adjustment. So real estate assets are classified as long-term if held for at least 24 months. So overall properties purchased after July 23rd, 2024, the day the union budget was revealed, will attract the new capital gains tax rate of 12.5%. So I reached out to Uday Ved, partner tax services at KNAV, to take us through the changes, but also to talk about some of the other fine print in the union budget exercise that we may not have paid sufficient attention to earlier.
So first of all, this is a welcome move. I think government is adaptive to taking suggestions, which is a good sense. What happened was on July 23rd, when the final union budget was announced, what it was stated is that if you were holding a property, be it residential or commercial, more residential, and if the property was sold after July 23rd, then the indexation benefit was proposed to be withdrawn, which is, I think, an important element when you are holding the property for a longer period. As a consequence of that, what it says that the rate of 20% will be reduced to 12.5%. So I think the objective of government was to simplify the capital gains tax scheme. To say you remove indexation benefit, but reduce the consequent tax rate from 20% to 12.5%. And that created a lot of kind of furor, the discussions, whereas on capital gains taxation or other assets was okay. But you know that these properties impacted a lot by inflation. And more the older the property, the inflation indexation benefit gives you a realistic picture of the cost of acquisition for the purpose of computing the capital gains. So the government took that suggestion and said now, interestingly, that for past properties, if you're holding it before July 23rd, then index it, you have a choice to be governed under the old law or the new law. What it means is when you transfer the property today or sell a property post July 23rd, 2024, you can either opt for 20% with indexation benefit or 12.5% without indexation benefit. So, which is good that, either of that, whatever is beneficial to you can be taken into consideration. That's a good welcome move. Just one point I would like to make it. There is always a devil in the details, right? That when you finally read the fine print, it says that the tax shall not exceed with indexation benefit or without indexation benefit. Theoretically, assuming there was no gain, but with indexation, it resulted into a loss. So take a situation which could be the scenario in real life situation today. You're holding a property for a long time, you do indexation, that's your index cost of acquisition, and the sale price is lower than the index cost of acquisition. So it results into a capital loss. That capital loss is not allowed to be carried forward as I read the fine print. It's only that the tax shall not exceed, and which is possibly a fair proposal, I would say. The furor was on the increase, but you could have a real situation considering the falling prices that it could result into a loss. So any property bought or acquired before July 23rd and sold after July 23rd, the capital loss, if it all incurred, not to be allowed. If you had bought a property and sold before July 23rd, you will still get the indexation benefit and the capital loss also. So that kind of scenario happens. But now if you sell the property and you have a loss, that loss cannot be carried forward because otherwise it's an 8-year carry forward for long-term capital loss, I mean.
But does this apply to other assets as well, or this is only in the case of real estate?
No, this indexation part is only in the case of land and buildings. So technically it includes not only residential house, I would believe also the commercial properties. As far as the shares are concerned, so you could have a lot of private equity deals which are happening, right? That tax is still capped without indexation. Only relief which has been given is if it was prior to July 23rd, then the rate is 10% and the rate is now 12.5%. One more point I will make, this change for the property is, I don't know why, but is put it only for resident and HUF. So assuming you are a non-resident and you got an inherited property and you are selling it, I don't think you get the indexation benefit as I read the fine print. That's one. Second, if you're holding the property in the name of a company or a partnership firm, again, the indexation is not possible. So I don't know why that change has been made, but that has been kept for people like us to keep on interpreting it, it looks like. But I didn't see the logic behind it.
Great. Among other fine print, Uday, that you've picked up, including on benefits for manufacturing?
There's one change for the new manufacturing unit. There is a tax concessional rate of 15% compared to a normal 22 or 25% for a company. And that ended actually as per the previous year budget to say that the manufacturing unit should have commenced production on or before 31st March 2024. That change came when the interim budget was announced in February of 2024. And a lot of people felt that that part was not extended. But there was an expectation that was an interim budget and that this is a substantive change which will come in the final budget. So on July 23rd also when it came, there was a silence on that, as I understand. There was no discussion also which happened. In the final print also we don't see that change. So as the law stands today, only for new manufacturing unit has started production on or before 31st March 2024, then that concessional rate is given, not otherwise. Generally, there was an expectation it will get extended by a year or two. But that's how the new manufacturing.
But this was also supposed to be like an incentive for manufacturing to expand capacity or new manufacturing to come in.
Absolutely. Like you have a PLI on that performance link scheme, but something similar, yeah, which has been there since 2019, and they kept on extending the date. But in whatever wisdom, that date has been kept as 31st March 2024.
Right. Anything else on the administrative side that you're seeing as we sort of close the book on the Union Budget 24?
No, I think otherwise, all the changes which came, we discussed that when the final budget was announced a couple of weeks back. And in that, lots of changes on the assessment, reassessment, rationalization of TDS rates, the Vivad Se Viswas scheme, all that continues. So there's no final change on that. So I think that way it is a good stability path. And the positive side is that the government is willing to listen to the changes of suggestions made by the people at large.
Right. And always a good note to end on. Thank you so much, Uday, for joining me.
Always welcome.
China's EV market. Now, this is an interesting statistic for the automotive industry in specific and the overall move towards sustainability in general. Electric vehicles and plug-in hybrids are likely crossed 50% of all vehicle sales in China for the first time in July, though the overall number of cars sold fell, according to Bloomberg. So sales of electric vehicles and plug-in hybrids, which are now classified as new energy vehicles in China, have touched about 879,000 units, which makes up about 51% of total sales. New vehicle sales, however, dropped 2%, according to figures released by the China Passenger Car Association. And Bloomberg says the milestone shows that the EV industry continues to enjoy strong momentum in China, even as demand slows in the rest of the world. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.